Let's dive deeper into the sharp reversal in the market today, with leading chip stocks buckling and prompting a bid in laggard groups in software, Mag 7 and beyond. So is this rotation going to hold? Joining me now is Dan Skelly from Morgan Stanley Wealth Management. Dan, good to see you.
Good to see you, Mike.
Been long awaited by some, and I guess maybe it's sometimes to be careful what you wish for if the leadership part of the market starts to give some ground. How are you reading the action today and whether we can extrapolate it out into the future?
So, look, the fireworks came early, apparently this summer, and it was quite a day. But we've been thinking about the risks around this crowded trade for the last month or so. And I think when you hear about the discussions on your prior segment around technical positioning, exhaustion, those may be true. But I would argue, Mike, there might be some fundamental risk emerging as well. We've heard about pricing wars among some of the model builders. We've heard about rental prices for old GPUs starting to decline. And we've also seen a shift in tone from Microsoft, who led the AI kind of launch 3 years ago with ChatGPT and their partnership with OpenAI. Microsoft now talking about a change in strategic direction for lower cost models.
Yeah, it's really interesting. I mean, sometimes the price action is required for people to ask those questions about, whether the underlying story is shifting a little bit. In a market where people have estimated 50% of market cap is in one way or another an AI trade, what does that mean?
It means you want to stay diversified, for sure, particularly if you have a focus on longer-term compounding, which is how we really try to position for wealth management-type clients. So within that, we've been particularly keen, Mike, on the last month or so, rotation into some of the regional banks, rotation into healthcare at long last, and even to some of the short-cycle industrial and cyclical names. I think many are perceiving the Iran de-escalation as sticking, and we think that's some viable ideas for diversification.
Yeah, it's interesting. We talk about this kind of seesaw in the market. Is it going to be the few or the many that are performing on a given day? And the premise seems to be there's not anything in particular we have to worry about the macro, right? I mean, because, on a given day in a certain mood, we can start to buy the cyclical stocks if we don't want the AI tech. Is that a safe assumption that the underlying macro is okay?
This is a really excellent point, and it's important. Increasingly, we're calling this economy unremarkable for two reasons. Number one, I think the market continues to look through policy shocks, whether it was Liberation Day a year ago, which we quickly retraced, whether it was conflict in the Middle East this year. The market continues to treat politics as pop-up ads, fading. And secondly, I think the market is increasing, and investors are increasingly coming to the consensus that this economy is more inflation resistant. And when you think about those prior two examples, tariffs and oil, the economy continues to grind through. So, yes, we would say the economy is surprisingly unremarkable, continues to grind forward.
I mean, it's easy to say, certainly in retrospect, that, the market shrugged off Liberation Day. It was a quick 20% gut check for the S&P 500. And people thought recessions, well, that's true. But in the moment, you're not sure if it's going to be shrugged up. So here we are, a few percent off record highs.
Sure.
Earnings estimates have completely carried the day in terms of supporting the valuation of the S&P. But is there any nuance in terms of whether the market's going to keep paying up for the earnings growth from where it's coming?
The irony in the nuance is that at an index level, the overall S&P has kept its multiple over the last year. It's really been this crowding hyper-concentration into the first-order AI CapEx winners. That is the anomaly. We think that area, that trade, almost has to roll over for the rest of the market to work. One of the clouds hanging around Mag 7 has been excessive spending. And so if you get part one, you ultimately, we think, get a longer-term rally in the rest of the index. Mike, it kind of reminds us of the history around 95. In 95, the first half of the year, semis had a 50% run and then took a pause for a year, but we were still 3 to 4 years left to go in the cycle.
That is true. Semis were not 19% of the S&P at the highs as they are right now, but your point is well taken. And finally, quickly, did anything really change from an investor perspective with the repricing of the Fed intentions last week?
So if I intellectually honestly say that the economy has moved beyond or incrementally past being inflation sensitive, I think the same logic carries through to the Fed. We were expecting incremental cuts this year. We've now been priced out. We're thinking maybe it's unlikely to have a hike given growth concerns. And so we would just argue that the Fed still matters in the long run, but lately has not mattered.
Yeah.